Good morning, ladies and gentlemen, and welcome to the Macro Ace live trade prep of Nonfarm Payrolls with your host, Tony. Just got about 5 minutes or so before we actually do start and go ahead with the prep. But I just want to see who's joining us live, who's listening in. How is everyone doing so far? If we're all doing good. Can you guys all hear me clearly and see my screen clearly? Fighting Nugget says hi. Good. All right. As long as you can hear me and see the screen clearly, that's good. So we've got quite a bit to cover today, as we did yesterday as well with the consumer spending report release that we had yesterday. But today we're Nonfarm Payrolls. We might as well start now and go through some of the details here. So first of all, we've got to understand what it is. Now, it represents the net amount of jobs that have been added in the economy in the prior month. So this data, the reason why it's such a significant release and everyone keeps an eye on it, is that the data that is collected the prior month is released the following week or in the first week of the next month. So that's why it's quite important, an important release and an economic indicator of how well the US economy is doing. And that's why it grabs a lot of attention when the release does come out as well. So also bearing in mind that the data is collected within a week. So it's not over the whole month that the data is collected. It's within a short time of within a week that the data is collected. So you have the establishment survey, and you also have the household survey. Okay, so the household survey collects data for the unemployment rate. That's interviewing about 60,000 different households of if they're unemployed or not. And then you have the establishment survey, which surveys around 440,000 different businesses, small and large, and to show or to ask how many people they have on their payrolls, who are part-time and full-time workers. So the non-farm payrolls figure itself, or the headline figure, is seen as a more important figure because of because of who they're asking for the data. They're asking businesses themselves to provide more reliable data that would give a better clue as to how the employment situation is within the US economy compared to the household survey, which still is quite key to bear in mind and to stay on top of how the unemployment rate is. But the household survey isn't as reliable as the establishment survey. Hence, we see the non-farm payrolls figure itself being the more reliable figure. Okay. So I've gone through their household survey and the establishment survey. Any questions so far, or does that make sense so far of what I've just explained? If you do have any questions, do let me know, and I'll kind of come back to you and answer that as soon as I can. So how does it affect the markets? So with currencies, usually when the economy is doing quite well, and we're seeing the economy is in an expansionary phase, the hotter the labor market is, the more of a chance that there is that the central bank, or the Federal Reserve in this case, would step in to curtail inflationary pressures and try to control that via raising interest rates. So for a currency in this typical environment, you would see an appreciation of the dollar, and that could happen if we do get a really strong report from non-farm payrolls. Then on the stock sides and also the indexes as well. Now, if as we are in this tightening cycle with the Federal Reserve, the key worry at the moment at the sentiment is, or what traders are looking out for is whether the Federal Reserve is going to hike by 50 basis points in the upcoming meetings in May and June. And we'll go through some of the investment bank views and where they view the Federal Reserve moving towards too, and how much tightening they're going to be doing, or how aggressive they're going to be in their tightening. But for stocks, usually, if we're not in the hiking cycle and the economy is on a normal trend, where we're not overheating or there isn't any low inflation or low economic growth, then usually stocks would tend to see an appreciation. But in this environment that we're currently seeing, when, as said, in the hiking cycle, and when the economy is really overheating, then that can be potentially a negative for the stock market if we do get strong figures coming out from the employment report. Not just for the non-farm payrolls figure itself, but you've also got to look at the other indicators too, such as the average hourly earnings, which is something that the Federal Reserve is keeping an eye on. How much spending power do US consumers have when it comes to buying goods and services? Then for the bond market, if we're considering if the economy is doing really well and the economy is in an expansionary phase, then for bond prices, what we've got to consider is that they can go lower. Okay, so in turn, treasury yields can go higher. The reason being is if the economy is doing well, then for traders, they are more likely to go to more risk assets such as stocks and corporate bonds. So the way that the government tries to entice traders to buy government debt is to lower bond prices and raise the treasury yield, or the yield of certain bonds, to try and bring people back in. So if the economy is doing really well, and you've also got the Fed who've already started to hike their interest rates. So back on March 16th, we've already seen that 25 basis point hike. Then treasury yields would see a further appreciation if the job market is shown to be overheating, and that would mean that the Federal Reserve will be more aggressive in their tightening, leading to an appreciation in treasury yields. And what that could do is bring bond prices further down. Good morning, Steve Rocks. How you doing? You're good? Any questions so far? Just whilst I'm kind of skimming through and going through the details here and what to expect. RPS Central says good morning. Steve Rocks says all good. Good. Okay. Let's move ahead. Like I said, we do have quite a bit to cover today. So non-farm payrolls. So according to economists, now the triggers that economists are looking at is with a high estimate of 700k and with a low estimate of 0k. So if I just bring up the calendar here for you so we can see that at the same time as well. So with the non-farm payrolls figure, the forecast today is for 490k with a prior of 678k. So actually looking for payrolls to see a decline, with the unemployment rate forecasted to see a decline as well to 3.7%, with a prior of 3.8%. Average earnings year on year forecasted to be higher, 5.5%, with the prior being 5.1%. Up here says, so my main concern from RIA perspective, my clients. What are we really facing? Okay, RIA perspective for my clients, and alongside trading is all of this data coming in on negative aspect overall with decreasing volume on the daily indexes. What are we really facing, and does that make sense? I think that makes sense. I think you're talking about with the negative. Let me see here. So I think what you're trying to say is that if we're seeing negative data overall with the current sentiment, how that's going to affect the indexes. Let me answer that in a little bit. I'll come back to that. I think that requires a bit more time to kind of go through in more detail. So going back to the triggers then. So what we're expecting. So again, private payrolls forecasted at 495k with a prior of 654k. Average work week hours to remain unchanged at 34.7, and the manufacturing payrolls forecast 32k with a prior of 36k, and the average earnings month to month also forecast to come in higher at 0.4% with a prior of 0%. So if we're looking at the other triggers then, so the unemployment rate, the highest estimate is 4.3% with a low of 3.6%. Remember, and then if we look forward ahead, so average hourly earnings, what we're expecting, highest estimate, that's the month, that's the year-on-year figure, by the way, that we're looking for. Highest estimate of 5.7% with a low of 5.2%. Okay, and then private payrolls with a higher estimate of 615k with a low of 175k. So if we look at investment bank views and where they see non-farm payrolls and the unemployment rate coming in, so you have JP Morgan with an estimate for non-farm payrolls at 550k with the unemployment rate forecasted to be 3.7%. So more or less near enough in line with the estimates we have today for the unemployment rate and non-farm data. Barclays seeing the unemployment rate remaining unchanged at 3.8%, but same as JP Morgan, expecting 550k, and then Deutsche Bank with their non-farm payrolls forecast of 400k and expecting a decline in the unemployment rate at 3.7% as well. So overall, most of the economists, including the investment banks as well, are expecting a decline in non-farm payrolls overall with the data that's due to come out today. Then if we consider ADP employment, now the ADP employment measures private employment change, but the only thing it doesn't do, and the reason why, I mean, it does gain traction, but the reason why it doesn't always correlate so well with the non-farm payrolls figure that we're expecting today is because it doesn't measure small businesses. Okay, so what it does, it just looks at the large businesses and how many jobs that they've added in the prior month. So their chief economist, Neela Richardson, said that job growth was broad-based across sectors in March, contributing to nearly 1.5 million jobs added to the first quarter of 2022. So there's quite a bit that's missed out from the ADP employment. As said, doesn't measure the small employers, well, it doesn't measure the small businesses, which I think if we're looking at the US economy overall is quite key to understand. If we're considering the large businesses, even when there's an economic downturn, usually those large businesses can sustain losses because they've accumulated a lot of wealth and to be able to and revenue to be able to pay off or try and survive any short-term depreciation in or weakening in the economy overall. So it doesn't provide the clearest picture as does the non-farm payrolls or the Bureau of Labor Statistics official reading does. But some people view it as that if ADP employment, if the figure itself is quite strong, even though it doesn't include small businesses, that could be a potential indicator for where the non-farm payrolls figure will be itself. So if we just want to make sure, so ADP, from what we had seen with the data that we had earlier this week, so it was 455k of jobs that were added in the private sector, whereas the forecast was 455k and the prior was 475k. So although compared to the forecast, it was slightly higher by 455k, it was lower than the previous 475k. So what does that mean for non-farm payrolls? could we see a similar reaction or a similar figure where non-farm payrolls drops lower? That could be that could be an indicator for that. If the ADP employment is slightly lower than the previous figure. But according to some whispers that have been heard on the street, let's say, the non-farm payrolls figure could come in at 527k. So still lower than the prior figure, but just to be aware of what some of the expectations are. Okay, so that's the ADP employment report. If we go to the next bit. Okay, so again, US private sector continued to hire at a robust pace in March, which was the data showed Wednesday. Right, market reactions. So the prior non-farm payrolls report was quite weird, actually, and maybe actually I wouldn't say weird. I'd say not a lot happened in the rest of the market. Although we did see is with the figures that we had. So the S&P 500, even though the data was stronger than expected at 678k, with the forecast being 423k, deviation was about 265k. We were looking for about at least a 300k deviation. Even then, although we'd seen a bit of a weakening on the dollar yen, which is the top bit there, and strengthening on the S&P 500, we had to bear in mind that the Dixie had been strengthening all day prior to the release. So any higher movement from non-farm payrolls figure, if you're expecting more of a stronger figure, if we did get a stronger figure over a 300k deviation from the forecast figure, then we would have seen a potentially stronger or more of an appreciation from the Dixie itself, and maybe a bit more of some weakening on the S&P 500 initially, and then seeing that move towards the downside. But overall, and also that's the 10-year yield or treasury yield, so just to bear that in mind, we'd seen that move towards the upside. Yes, says nice, something new. Steve Rock says usually DX and Dixie and gold give you large moves, but last NFP was negligible. Yeah, so this is what I want to show you, the market reaction. If we bring up the recording that I made. So just to bear in mind, so the markets, after the release had occurred, the markets shrugged off the release, i.e. there weren't any further strong moves in the markets. So where we had seen yields and stock futures had started to slide in the wake of the escalation of the Ukraine conflict. Now, if I bring up the video here, just cautious of time, we've still got plenty of time. Right, so this is the last NFP release that we had. Just make sure I can actually play this here. Let's see if it plays the right one. Okay. So again, here we go. So this is, yeah, as I said, the last release we had from non-farm payrolls. Okay, so the figure came out better than expected. Did see that initial move towards the upside on the dollar yen, and then the S&P 500 had seen that move towards the upside as well. And then we started to see some weakening on the dollar yen. Gold did see, if we're looking at over there, did see some strengthening. So the opposite reaction happened. Although the initial reaction was positive for the dollar yen and for the dollar overall, didn't react in the way that I was expecting, where we were expecting the S&P to see some weakening. And then also the dollar to see some more strengthening off of the back of the release, and then gold to also see some weakening as well. But due to the Ukraine conflict, taking over the overall sentiment, where indexes were seeing an overall decline with with the war occurring, and also WTI and crude oil prices soaring off of the back of the conflict. We didn't, as I said, we didn't see the overall, didn't really see an overall strong reaction to the report after the initial, let's say, couple of minutes or so. So here you go. So the first minute, so that's done. That's done there. If I bring up the deviations too, that will also be quite useful for us to have a look at. So again, as said, the deviation that we had for the figure was 265k, and on the first candle for the S&P 500, we'd seen about 81 ticks towards the upside. On the dollar yen, we'd seen about 6 pips towards the downside. Gold seen about 23 ticks towards the upside as well. Now, the other currency pairs that we had seen didn't really see a strong reaction. It was more or less muted to a degree. So what we got to keep an eye out for today is, now that things have slightly settled down with the Ukraine-Russia conflict to a degree, we're seeing more of a more normal market conditions, I think, where we're not seeing hectic or extremely volatile moves as we have seen in the past. Although saying that, if I pause the video and bring back up our presentation. So that was the, so here we go. So this is the deviation that we'd seen from the last Nonfarm Payrolls figure. Again, it was about 265k. We were looking for about 300k at least from what we've seen in the prior releases that we had, where we had seen actually stronger moves on the dollar yen, and also there would have been on the euro dollar as well, and cable. But as said last time that we had these figures, we didn't see again the reaction. Although it was a negative reaction for the dollar, wasn't that much of a movement. It was very weak compared to when we had received figures prior. So going back to the 4th of Feb, when the figure was much better than expected, of at least 300k of a deviation, we'd actually seen about 58 ticks down, 31 pips up towards the upside on the dollar yen, and about 68 ticks down on gold. So again, the sentiment at that time was that, will the Federal Reserve hike by 50 basis points in March? Of course, that didn't happen. And then 4th of March, we had the sentiment of Russia-Ukraine conflict that had taken over the market, had moved, or was moving and still is moving, market volatility to a degree. So what we're expecting today is, if we do get stronger figures, will that play into the hand of the Federal Reserve looking to tighten monetary policy much more? Remember, the more jobs that are added in an economy, that leads to more spending that consumers have. If they have a job, they have more money to spend, which in turn will lead to inflation picking up some steam. And then if inflation is higher, or it still runs quite hot, and the Federal Reserve's tightening isn't doing enough, then that could potentially lead to tighter monetary policy, and that could lead to a further appreciation in the dollar, and a depreciation in stock indexes, and appreciation in treasury yields. But one thing to remember as well, I think, with gold, it is a safe haven asset, and it is considered an inflation hedge. So one of the things I think we've got to be aware of, I think, overall for the market conditions, with inflation being quite high at 7.9%, if we look at some of the other indicators now that are weighing in on sentiment, so you have CPI at 7.9%, which is still at a 40-year high. That could play into the hand of gold, where if inflation does get out of control and the Federal Reserve's tightening isn't doing enough, then what that could mean is that people could fly to gold, could move towards gold instead. Usually when inflation gets out of control, that makes the currency's value, or that makes the currency less valuable. and the more value is added onto tangible goods, okay, or tangible assets such as gold. So if inflation does get out of control and the Federal Reserve tightening isn't doing enough to curtail that, when we do get upcoming inflation reads, then that'll be one thing to consider, that gold could see more of an appreciation compared to the dollar and other assets. But if we're going back to the other bits of indicators weighing in on sentiment, then as said, CPI at a 40-year high at 7.9%, month on month at 0.8% for the last release we had received. PCE price index, again, remember the PCE price index is the preferred measure of the Federal Reserve when looking at inflation. The reason being is that the PCE price index doesn't measure a fixed basket of goods, i.e., for example, let's say beef was really expensive this month, but consumers were actually buying more chicken. Then the PCE price index, instead of focusing on beef, it can decide to focus on chicken prices, giving more realistic view of where inflation is compared to the CPI report. So again, that's why the Federal Reserve keeps an eye on the PCE price index more so than the CPI. So we're seeing 6.4% for the year on year, which is actually a 32-year high from what we've seen with the PCE price index, and then the month on month at 0.6%. So bearing in mind, if you've seen a lot of the comments that have come through during the monetary policy meeting minutes or the statements and other central banks as well, then you'll notice that they always say that 2% is their inflation targets. 2% is where the economy is not running too hot, but it's not running too slowly either, or too cool. But clearly, as evidence as we've seen so far, that's running way above the Federal Reserve's point of view, or of where inflation should be. So again, that's one thing to consider as well with the non-farm payrolls release. As said, more jobs, more money consumers have, more money consumers have, which will lead to more spending and can lead to higher prices. Also to bear in mind, if we are talking about other central banks as well, so you've had the Eurozone with their inflation reading at 7.5%, which again is another record high since the euro or the ECB was created. So that's also, again, they have the same rhetoric. 2% is their inflation target as well, and we're still in a very hot inflation environment. Moving on. Core PCE price index, again, something that's is a preferred measure of inflation for the Federal Reserve at 5.4%, the biggest rise since 1983. GDP, what we'd received this week, it was estimated to finish at 7% for the quarter, but we'd actually seen it was at 6.9%. So no change from the prior quarter that we had seen. So Q4 21 finishing off at 6.9%. Then in regards to the jobs and the labor market environment, okay, so there's still room for more jobs to be added in this recovery environment that we're seeing. So we're about 2.1 million jobs below the February 2020 peak. So that can mean that we can still add a lot more jobs to the US economy, which in turn can add to the overheating of the economy as the labor market starts to get tighter and tighter. Working hours, unemployment duration, jobless claims have also returned to pre-pandemic levels as well. And then the unemployment is about 0.3% above 3.5% pre-pandemic levels. So we're getting towards back to normal with the US economy and where the employment situation is at the moment. Then some Fed views. So Fed's Bostic, so he repeated favoring raising interest rates 6 times this year, but can go faster or slower depending on how the economy evolves. So what he did say earlier this week, and what he's also stated previously, is that if there is a slowdown of the economy, then he would favor raising rates by less than 6 times. But if the economy is shown to be much stronger or is overheating much more, then he would look to favor raising rates by even more, or raising rates even more. Remember, he is a voting member of the Federal Reserve, so a lot of traders have been keeping an eye on his views, but I think it's correct to say that everyone's keeping an eye on all the Federal Reserve members' views, even Fed's Bullard as well, who is a very hawkish member. His comments in the past, when he was looking for at least 100, or was looking for 100 basis points by July, that caused a negative reaction in the US indexes, where the indexes had seen a depreciation and the dollar had seen an appreciation. Okay, so to be more specific with Bostic, saying he sees 6 hikes this year, 2 early next year, and that gets to the estimate of neutral. Remember, the neutral rate that the Federal Reserve is talking about, where they want the interest rate to finish at, is at 2.4%. Okay, that's their neutral rate of where they want to get the interest rate to. So whenever any Fed members do talk about reaching the neutral rate, that's what it is. So Bostic, as said, sees 6 hikes this year and 2 early next year. But the world is going to happen, i.e. with the Ukraine-Russia conflict, and that will temper my view on how fast or how slow we should get back to that neutral level. So again, the Ukraine conflict also impacting the Federal Reserve's view on how that's going to affect inflation. Powell did state that with inflation with the Ukraine conflict, that is adding some pressure to prices for energy, food, as a cause of particular concern for the Federal Reserve and Powell. So the Ukraine conflict is, and when Bostic does say that the world is going to happen, that is having an effect on the US economy overall. Powell says the current labor market is much tighter and much hotter than pre-pandemic levels. So again, does that mean further or faster or more aggressive tightening from the Federal Reserve? Could mean that we might get the 50 basis points in May and June, or do we just get 50 basis points in May or June itself? Okay. Also, other bits to bear in mind as well. So Morgan Stanley and Bank of America. So they say the resilience has taken some equity strategists by surprise, while Morgan Stanley and Bank of America have urged investors to seek opportunities to sell the rally. JP Morgan's team disagreed, saying that economic indicators are so far beating expectations and that it's too early to position for a recession. So there's this talk of the US 2-year yield and the 10-year yield inverting, and that being seen as a sign that a recession is coming. But what we've got to understand is that when that inversion does occur, usually the timeline for a recession to actually occur takes about 18 months typically. So that's one of the reasons as to why the Federal Reserve doesn't focus on the 2 to 10 year. They say that we should be focusing on the shorter term bonds, such as the 3-month bill, as that's where the Federal Reserve has a lot of sway and a lot of power in controlling short-term rates. Of course, whenever the federal funds target rate is raised, then of course that will boost yields. But the shorter term yields are the ones that we need to be focused on. And at the moment, we're not seeing an inversion as of yet in in the Fed's view of looking at the US 3-month bills or the shorter term bonds. So does this mean with the 2-year yield, with the 2-year 10-year yield inverting, are we going to see a recession again? In the Federal Reserve's view, they don't see that happening. They do, however, take into account that with the yield curve inverting, that there could be some signs of trouble, but they haven't specifically said that that's going to cause a recession or that's going to lead to a recession. So I think the key thing to remember is the markets at the moment are very sensitive to, one, the Ukraine-Russia conflict, two, the Fed tightening cycle, and also other central banks in a tightening cycle as well. And those two bits put together are increasing volatility. So that's probably why we're seeing a lot of traders focusing on the 2 to 10 year yield to see where the economy is going to be headed. And any sort of whiff of a recession or any issues within the economy causes a more of a risk-off environment where indexes see depreciation, safe haven assets see more of an appreciation. So I think we've just got to be careful of the oversensitivity of the markets that we might be seeing at the moment. Then in regards to other comments about the treasury yields, so on 31st of March, we had treasury yields that extended a 3-day losing streak with the 10-year down to 2.335% from 2.35% Wednesday. And there was news that Biden is going to be releasing up to 1 million barrels of oil a day from US reserves, which stoked hopes of inflation relief. Now, remember, if you have higher oil prices, then that can lead to higher inflation readings further down the line. So by providing oil or more oil or releasing more oil to the markets, then that can cause oil prices to depreciate and make it put less pressure on those people, those businesses providing and making those products using that oil to actually start to decrease prices. Does that mean that's going to have a long-term effect on the market? I think with the 1 million barrels per day being released every day, we're yet to see. But the initial reaction, what we had seen, there was about a 7% drop in WTI crude oil when that news had come about that the US was looking to release more oil from their reserves. Also affecting treasury yields as well. So you have the also weekly jobless claims rising to 202k, and then investors waiting for Friday's non-farm. That's also weighing in on sentiment too. And then again, as I talk about oversensitivity, the 2-year yield remaining very close to the 10-year benchmark at 2.306%. So investors, again, just worried about monetary tightening could lead to recession. So why am I going through this and talking about the treasury yield and how that's affecting sentiment? Well, if we do get a stronger non-farm payroll reading, and what we had seen of in the past of at least a 300k deviation, and we do get that strong reaction, then we're expecting we could see US indexes see a decline off of the back of that, and see the DXY see some strengthening. The yield curve, so from the White House's view, they say that all signals are that this is a strong economy and the probability of a recession within the next year is not particularly elevated. That was according to the White House Communications Director Bedingfield, who made her comments and briefings on Wednesday, citing Powell's remarks early in the month as well. Okay, right, so we have about 10 minutes until we get the release for non-farm payrolls. I think now is a good time to go through some questions. Anything you guys want to go over again? Anything that didn't make sense? I've spoken a lot. But yes, anything you guys want me to go over? Actually, let's have a look through the comments just to see what we have. So actually, let me get my chart set up as well first. make sure that we've got the right chart so we can see. So we go S&P, got the dollar yen, gold. I think we would also want to keep an eye out is for euro, dollar. Let's get some of those more exotic ones in too. Let's get the some commodity based currencies. Let's get the NZD. So far, I'm also just keeping an eye on the headlines as well. I know in the past when there have been some positive headlines or negative headlines coming from the Ukraine-Russia conflict, then that does sometimes mean that that there is no market reaction to some releases. Let's see. Okay, so my 30-year too. Let's get ZB. Okay, so got my 2-year, 30-year. Got my S&P. Let's get the Nasdaq. All right. Gold. There. Okay, so I think we're going to be covering all bases here today. All right. Alrighty. Okay, let's look through some of these questions. So Kurt B says, what happened yesterday on the ES? Well, yesterday, remember there was, if we have a look at some of the news from yesterday, there was some news that, first of all, Russia wasn't pleased with where the Ukraine-Russia negotiations were. And we had seen, if we actually bring up the charts today, we can see. Okay, let's bring that up here. So if we're looking at the 31st yesterday, so we'll just bring up some of that news. So remember, so there was some news yesterday that Putin actually, he did make the threat that any active contracts would be cancelled if there weren't any payments being made in rubles for gas contracts. So overall, that was taken negatively by the markets, where there was an escalation in the conflict. Of course, remember, Europe imports a lot of its energy from Russia. It's about 27% of energy that Europe uses, or oil that Europe imports, comes from Russia, and about 46 or 47% of liquid natural gas comes from Russia as well into Europe. So that headline, or those headlines of Putin threatening to withdraw contracts and cancel contracts, had seen a negative reaction on the S&P 500 from that bit of news there. So that was one of the key bits of sentiment that drove the markets yesterday. Okay. Annuel says, interesting room, and news on balance sheet reduction. So the balance sheet reduction there, so the Federal Reserve has about $8.9 trillion on their balance sheet. They haven't made any specific comments of when they'll, or they haven't made any, haven't said how much they're going to reduce the balance sheet by. The only thing they have said is that it is something that is new to them. The only time they used it beforehand was back in the 2007, 2009 recession, the housing market bubble, as when they had a large balance sheet. But in this, so this is the second time that they've been using the balance sheet as a way to provide support to to banks and the economy. But they haven't mentioned how much they're going to decrease their buy, although they do want, and Fed members have said in the past, that they want to be quite quick to reduce the balance sheet to get back to normal. So if we do get a potential of 50 basis point hikes in May and June, then I would expect that they'll start to want to reduce the balance sheet quicker. So remember, a lot of the Fed members, some Fed members have said that once they get to around neutral, i.e., don't forget the neutral rate for the interest rates in the US, they see it about 2.4%. Once they do get close to neutral, then they'll start to make those reductions with the balance sheet. But no specific amount has been mentioned as of yet. So we've got about 5 minutes until we get the release. Whoa, let's... I had turned my head to the left and I turn my head to the right and I see all these other questions as well that I've missed. So let me just kind of backtrack to RIA perspective. When you say RIA perspective for your clients, what are you talking about there, RP Essential? Actually, if I remember what you were asking, so I think I've already answered this in the questions, or in what I said in the presentation of what we're really facing for if you're talking about your clients and what to expect. So sentiment-wise, I'll go over it again. You have the Federal Reserve and central bank tightening cycles that are occurring globally, which are putting pressure on indexes, and they're seeing some negative reaction, and the currencies, such as, let's say, for sterling, the dollar index are seeing an appreciation in value. So in that tightening cycle, indexes and stocks aren't seeing much love from the central banks, and are seeing a depreciation. And then, of course, with the Ukraine-Russia conflict, that has also affected oil prices, which in turn we're yet to expect how that's going to affect inflation overall. But of course, we're already starting to see some signs of that with inflation in the euro area, where we've hit another, as said, we hit another record high at 7.5%. Remember, the prior for the CPI in the Eurozone area was 5.9%. A lot of that was to do with the energy prices that we're seeing a further increase, of course, as there's less coming in from Russia in regards to liquid natural gas and crude oil being used by European countries. So central banks and the Ukraine-Russia conflict are the key things to be aware of for your clients, if I've answered your question correctly. Let me know if I haven't. What else do we have? A lot of people saying they like the live feed. Good. Is everyone finding this information useful so far? Is it proving to be useful to make you aware of what to expect before about 4 minutes before the release? Actually, let me get tick strike open too. That's one thing I don't want to lose out on. Don't want to miss. Ooh, what's that? Okay. Unusual activity. Hey James. That's our boy James from Unusual Activity. Give a hit up to those guys as well, covering stock market news or the unusual activity in stock markets. Because other people saying, yes, very, yeah, I'm going to trade Aussie dollar to the US dollar. Miss MB, very much so. James Duras says, first time here, I like it. Good morning. Good morning to you too. Steve Rock says, good, very good. And triple yes or ye. I don't know why I did that. Says yes. Galaxy says, will there be a macro ace market wrap? So usually what I tend to do at the end of the week. So we've got about 1 minute to the release. So let me answer those questions in a bit. Well, actually, less than a minute. 40 seconds. Let's bring up here. Okay. Let me bring that there. All right, hopefully you guys can see the financial site clearly. Oops, sorry. Let me go back to there. Okay, there we go. Right. About 10 seconds to go now. So let's get our... All right. Let's see if we do get a at least 300k deviation. About a second. Okay, 431k. That's lower than the forecast. 490k. Wow. Okay, so dollar yen seems to move towards the downside there. S&P. So wow, it's quite mixed actually. So more of a mixed reaction on the S&P 500. Did see the initial move towards the downside. Dollar yen now moving towards the upside. Unemployment better than expected at 3.6%. Forecast was 3.7, prior 3.8. With the private payrolls much lower than expected at 426k. Forecast was 495k. Manufacturing payrolls 38k, better than expected, or 32k forecasted. Average hourly earnings up at 5.6% compared to the forecast of 5.5%. Just keeping an eye on the market reactions too. So this is some so we did see the initial weakening on the dollar yen, and now we're seeing some move towards the downside. S&P 500 did wow, very mixed reaction here. This is quite a messy release. Private payrolls coming in at 426k with a forecast of 495k, so lower than expected. Also lower than the prior figure as well. So I think the key thing to remember is non-farm payrolls lower than the prior figure. Didn't see our 300k deviation at least to get the really strong reaction that we'd wanted, or the direction that we'd wanted. Dollar yen seems to move towards the upside. Cable seems to move towards the downside. So a much cleaner reaction here from what we can see. Cable, euro dollar seems to move towards the downside. Aussie dollar to the US dollar. Let's bring up the lines. There we go. Did see some movement towards the upside there on the Aussie dollar. A quick reversal, and same with the New Zealand dollar as well. Did see that quick reversal. So did see that move towards the upside, and then that reversal there. S&P again. 31, more of a mixed reaction. NQ. Okay. Okay, so NQ moved down as well. All right, let's have a look at some of the other areas. Let's have a look at the treasury yields. Okay, so keep an eye on the ticks. So seeing bond prices moving down. We'd also seen that's on the 30 years. Now we're looking at the 2-year. Also seeing some move towards the downside there on the bond prices for the 2-year. Gold, not really a clear reaction. Okay, did see some movement towards the downside on gold as well. So overall, if we're looking at what we've seen here, so seeing some strengthening on the euro, on the dollar yen. Reminder with the figures, so the unemployment rate came in much better than expected by about 0.2 deviation from the prior figure, and about 0.1 deviation from the forecast figure. Average earnings is up, but overall, the non-farm payrolls wasn't too much of a deviation. So there was about 59k deviation there. Let me put that in here. Yeah, so about a 59k deviation from the forecast figure, from the actual figure compared to the forecast figure. So not a very although it not a very big deviation. So I think that's probably one of the reasons why it's interesting here. So the dollar is seeing some move towards the outside, S&P towards the downside, as does the Nasdaq. Let's see what else we can get from the report itself. So there were notable job gains that continued in leisure and hospitality, professional and business services, retail, trade, and manufacturing. Okay. I think also one thing I don't want to miss is the labour force participation. So that was more or less in line with expectations. So overall, more of a mixed release here from the report itself. What else are we seeing? So we're considering where the S&P was. So we had already seen a huge move towards the downside yesterday. The market hasn't even recovered from the news yesterday of Putin potentially cancelling current contracts. So it's still, markets overall, although the S&P 500 on the futures is up about 0.15, the Dixie is up about 0.26. Well, it was up on the day already. So again, I think it seems to be that the markets have kind of brushed off the release again with the Ukraine Russia conflict, which has taken center stage. So not a strong reaction from, let's say, the dollar, or a sustained strong reaction. Okay, euro dollar, that's still okay. Gold. All right, let's see how many ticks we had. And pips as well. About 5 pips towards the upside on the dollar yen. Okay. Cable. Make sure we're on that there. Whoops. Should be. It's about 4 pips was the upside on cable. About 5 pips there. Euro dollar. It's about 8 pips towards the downside. Aussie dollar. Okay, so that's about around 9 pips, or about 8.5 pips towards the upside there on the Aussie dollar. So it seems to be that the Aussie dollar and the New Zealand dollar had more or less the better reaction in regards to how I would have expected the markets to react against, or the dollar to react. See the dollar weakening, but didn't really see that on with the dollar yen cable, or the what kind of slightly on cable there. Didn't see it too much on the euro dollar where the candle had ended. Let's look at USD CAD. That'll be. Let's see if they had a similar reaction to the others. Okay. There we go. So yeah, US again, not the same reaction as we had on the Aussie dollar, the New Zealand dollar. Again, dollar weakening against some other currencies. Excuse me, strengthening. That's about 6.5 pips towards the upside. Okay, let's look at the S&P. See how many ticks we got. 30. Oh, it's about 17 ticks towards the downside. Let's look at the Nasdaq. We ticks. Should get that correct. Okay, so that's about 60 ticks towards the downside there. Gold. It's about 18 ticks. And then let's look at the bonds too. Seven ticks down. About 10 ticks down. Okay. Somebody said best strategy, don't trade into NFP. What else? Like at the end of the day, let's see. Whoa, I think I missed some comments here. Going back to, so John Friedrich says more discussion of strategy would be good, like at the end of the day of the week. And then Steve Rock says best strategy, don't trade into NFP. Good morning, Uzor. Destiny says good morning. This is great. Steve says you will learn what real slippage is. Rather lackluster response. FDARS says great job, FJ team. Thank you very much. Kurt B says haven't touched it yet. Okay. Yeah. So the response to the release overall. Just getting some IEA comments coming through. This framework. IEA Director General Grossi says, I have an established framework on nuclear security and safety in Ukraine, but it is being agreed independently with Ukraine and Russia. Okay, so a mixed reaction if we're talking about the dollar where it headed or how it reacted. So the Aussie dollar, New Zealand dollar reacted in the way that I would have expected the dollar to react, where I would expect it to see some weakening of the worse than expected data. Then we have this choppy show where there isn't too much of a clear direction as of yet of where that's going to go. And then on the dollar yen, again, not really a strong reaction from the figure itself. It just kind of, it's seen a bit of initial move. Well, we had seen some of this move to the downside as well, but then finishing up slowly up by about 5 pips. Just bear in mind that's showing, to make it a bit easier. So if you are looking at that, that's saying pips, not ticks. But yeah, that's about 5 again. So about 5 pips was the upside. So not really a strong reaction from the release overall. Kind of just happened, and now the markets are continuing the move of where they are so far. Gold again, similar reaction, about not really a strong reaction, about 18 ticks down, and then seeing some movement back towards the upside. So continuing again, what we're seeing overall. If I bring a different chart picture, we can see better here. Okay, so we'll zoom out. Okay, so the S&P is still up about 0.7% on the day. Dixie not really changed too much. It was up. I mean, we've seen in the past, we've seen some stronger moves here earlier on in the day. So more or less mirroring those early moves. Not seeing too much of a strong reaction. USD CAD. Nope. No real. Well, there was a reaction, but not really a strong reaction in one direction. gold, similar there. Very choppy. Crude oil prices, WTI crude oil, again, similar. No real reaction there. Bitcoin, if you're a Bitcoin trader, I always like to just keep an eye on it, see how it reacts. But I think if the dollar's up overall, well, actually, at the release, yeah, so at the release, did see some movement towards the upside there, and now it's seeing some continued movement towards the upside. So I think it's quite an interesting release that we've had so far today. Any questions? Did anyone trade? Steve Rock says, "Gotta go, but very well presented, and thank you. No worries." Yeah, has anyone? I believe I saw somebody saying they were trading the Aussie dollar on that release. Probably a good idea too, considering how the initial reaction was on the other currency pairs. Okay, so just to go back to some earlier questions, I think someone had, is there a market wrap at the end of the week? So usually what I do is the market wrap that I'll post out, or the economic trade prep that I'll give out for the week ahead. That will include what to expect, as in what's the top bits of news and the releases that we're expecting. So at the end of the week on the Sunday, usually I'll pop out something for you guys in our mailing list, which brings me to my next point is, if you liked what I provided today, or Macarace provided today, you can sign up to our mailing list and stay up to date and stay in the know of what to expect for these major economic releases. Now, today we've got the ISA manufacturing report coming out from the Institute of Supply Management at 9:30 a.m. Eastern time, so we're starting our prep for that. So if you do want to join us for that, then I'll put the link to that video too, so you don't have to faff around with anything. I can just put it in here for you. That is the link for you there. So that's the next event that we have coming up in less than an hour. So again, first link I've put there is the mailing list, so you can stay up to date and with what to expect. And the next one is the ISO manufacturing prep stream that I'll be doing later on today. If you do have any questions, do feel free to email me at tony@financialjuice.com. Okay. So, yeah, so you can email me at tony@financialjuice.com for any questions. Feedback is welcome. If there was something, so I think John Friedrich mentioned more discussion of strategy would be good. Again, if that's something that you guys want me to include, that's something that I can work on and have a think about. Remember, the key thing for this product to work and to succeed is for you guys to be brutally honest with a product. Is it really useful? Has it helped you in your trading and understanding of economic releases? Do you want to see more of these live stream videos? If yes, then perfect. If not, tell me why. What was the reason for if the video wasn't useful at all? So also as well, we would also want software. We would also want feedback on software to trade news events as well. So what are your thoughts? What are you looking for when you're trading the markets? What kind of software do you look for? But that's also, again, ideas and feedback is all welcome, that we would look for from you guys. Somebody said he's talking about the yield curve inverted. Let's keep an eye. I think at the moment it's, let's see. US 2-year bond. Okay, that's 2-year bond yield. So 2-year bond yield is at 242. I think just to make sure, just to make it make you aware, the Federal Reserve doesn't consider the 2 to 10 year or the 2 to 10 year as a as a measure, or a measure of if the economy is headed into a recession. What they're expecting, or they're looking at, is the shorter term yields, so the 3-month bill auctions. So at the moment, the 10-year yield, just out of curiosity, anyways, the 10-year yield bond yields at 2.423%, and the 2-year yield is at 2.434%. So a bit of an inversion there, where the 2-year yield is higher than the 10-year yield. Again, that's, as the Federal Reserve have mentioned before, it's one thing to be aware of what's going on, but it isn't something that says that there is a flashing lights of it's a recession, it's going to happen pretty soon. So that's one thing to consider when you're looking at the 2 and 10 year and the yield curve inversion that we're still currently seeing at the moment. So if I bring it up for you guys to have a look and see, there we go. That's the 2-year yield, and that's the 10-year yield at the moment. Okay. Mike, yes, says Mike is a tad low, but content is good so far. ISMF says, in all caps, useful, more please. No worries. Good. Okay. Thank you very much for joining us. We will catch you later at 9:30 a.m. Eastern time for the ISM manufacturing report and trade prep. For now, thank you very much for jumping on. Enjoy the rest of your trading day, and also enjoy your weekend if I don't see you later on. Thank you.